Hello, everybody. We're going to start at 4 p.m. sharp. We're waiting until it's 4 to start our webinar on financing a Series A. Welcome, everybody. Today, it's Javier Ekari from CEO of EBN who will be moderating this session in the framework of EU project InvestHorizon. Hi, Javier.
Hello.
Our session is going to start in a few seconds. People are still signing in. Welcome, everybody. We're going to start in a few seconds. Welcome, everybody, to our session on financing a Series A presented by EBN in the framework of EU project InvestHorizon. I'm going to give the floor to Javier Echari, CEO of EBN. He's going to moderate this session.
Good afternoon, everybody, and thank you for joining us. This is the very first webinar that we do of a, in principle, long series of financing and access to investments webinars. This is part of a EU framework program that I'm going to tell you about in a minute. We will also be doing online classes on the same topic, on accessing finance. And this is from Series A onwards. So not the very, very early stage, but something a little bit more mature for companies that want to move up and certainly scale up. In order to do that, we have invited two speakers that have, by their background and by their current positions, they have their stories to share with us. Vincent Koenen, who's the founder and CEO of Hadean 7, a very successful entrepreneur and company, and he'll tell us about not only the company but also his pathway to get all the way there, which nothing is as easy as it may look. And we've got Roger Franklin. Roger is a partner from Hadean Ventures to give us his perspective from the venture capitalist perspective on expectations, on misalignment, on the whole track record required, but most of all, what does the venture capital want to see? So we're going to have two very different views. We have asked both of them to be blunt, outspoken, clear, so that everybody participating in the call can grasp a little bit better what it is like to go on the road looking for funding and what each of us should be expecting. The plan for today is relatively simple. I'm going to do a very short presentation on the program that is hosting us, and we will ask both Vincent and Roger to tell their story for 10 minutes, and we will go into a longer 20-minute Q&A session. Now, for all of you, this is important. You can all write questions as we go. Don't wait. On the panel to your right, normally, on the GoToMeeting panel, you have a little box where you can ask your questions. Perrine and Marta are here behind the screen, pulling all that together. And then once we get to the Q&A session, they will be coming up and posting your questions to both Vincent, to Roger, and or myself. And I also have, as you can expect, my battery of questions ready. So without more ado, and thanking in advance already Vincent and Roger for your participation, we will get kicking here with this webinar, which is meant to last for 30 minutes. So please stay with us. Can I have the next slide, please? Wonderful. InvestHorizon. Now, InvestHorizon is one of these many EU programs, which for people seem to be very complicated. In reality, the EU is doing an enormous amount of things to try to facilitate the setting up of companies, the drive of innovation altogether, whether it is research-backed or not, and then accessing finance in one way or another. They obviously can finance a number of things as grants, but mostly, and because of state aid rules, they can facilitate the fact that financing happens. And this is what we do. This is what we do with InvestHorizon, the program. As I said, we will be doing meetings, we will be doing online classes, and we will be doing webinars like this one during quite a few months. I think we are going to run this program for about 3 years, close to 3 years now. Now, it is about posting investor readiness. So you have the tech entrepreneur here, and you have the entrepreneur looking for Series A. Now, venture capitalists and business angels and entrepreneurs don't always mean. Our purpose is to reduce the time that it takes for that meeting to happen, for a better comprehension of what is done, no wasted time in the effort. And obviously, we want to strengthen the pitch of the entrepreneur to the venture capitalist, and we want to make sure the venture capitalist is going to understand better what the entrepreneur is expecting. Now, Series A very often add on through a syndicate. So now we've got Roger here to give us his view, but you will probably have to talk to different VCs, and maybe one VC is going to introduce you to others, and each of them will have a slightly different version that we need to manage. But that is a personal management that you will have to do. What we try to do is give you as much information as we can to make sure your investment is done in a more fluid manner, and obviously we will try to come up with matching capacity. Now, if we move on to the next slide, please. We are not alone, so this is not just about EBN, but let me explain. We have quite a few partners here. This InvestHorizon is financed both by the European Commission and by Eureka, and it is led by one partner, one among us, which is Tector, which has a very long experience in running matchmaking exercises, events, etc., for Series A and beyond. And I definitely encourage you to check what Tector does. Other partners in the group are BPI France. Everybody knows BPI France, and not just in France, but beyond. The Meta Group, which is a fantastic consulting company working with us in Brussels very often. BWCon, one of our members, also very heavily involved in quite a few projects, and not just in pure financing, but also in artificial intelligence, blockchain, etc. Eura, which is coming with finance technology. IESE, the very well-known business school, and COCF. Now, ourselves at TBN, we are the European Business Innovation Center Network. In short, incubators, accelerators, and business support organizations, all of them busy with innovation, and all of them certified. There is a quality of service. And that's the reason why we all got us together. Each of us are coming with a different background and a different capacity, and we're trying to offer this to you through this program. Now, without more ado, I would like to make sure that that we kick this exercise, and I'm going to ask Vincent to maybe be the brave one to tell your personal story about going on the road, trying to fundraise, telling what your company is about, your idea, and give us all the takeaways that maybe each of us can use for our own fundraising. Thank you, Vincent. The floor is yours.
Okay, thank you. Do you hear me correctly? Yes? Do you hear me?
Yes.
Okay.
Yes, we do, Vincent. Fine.
Thank you. Can you go to the next slide? Hello, everybody. I will quickly introduce what we are doing. So first on this slide, Andaman is a company created in Belgium, and we have an office in California, in the Silicon Valley. We were created 4 years ago, as you can see. We are a small team of 12 persons, most of them in Belgium and one in the US. And the goal of the company is to create a platform that allows patients to collect all of their health data on their smartphone and only on the smartphone. So there is no storage of medical data in the cloud, which means that it's very secure first, and also for privacy matters, this is a very strong proposition. So one side is the patients collecting their data on their smartphone. This part is free. We wanted to have a social part of a social goal with the company. So if you go to the App Store or Google Play and you search for Andaman 7, you can download the app free and you can start managing your health data yourself. And then since this is the free part, we need to generate revenue, and we generate revenues by allowing pharma companies or medical devices companies that need to run clinical trials with questions being sent to patients. And so patients are recruited by doctors, and doctors can then recruit patients to have them run the clinical trials. So you will be invited to be part of a clinical trial if you want to be part of it. The third part is we gradually building a relationship with some hospitals to run patient monitoring at home or what you could call telemedicine. So with the mobile phones and video, there are a number of things that you can do to follow up on patients, especially chronic care patients, patients with heart problems, patients with diabetes, and those kinds of chronic diseases. This is a global project, so we are born global startup, as we like to say. The platform is available in 22 languages. So most of the languages spoken, the main languages spoken on Earth, and then we can add new ones very easily. So that's for the company. That's for the project, the product we're building. We also raised 3 million euros in 3 rounds, mostly from business angels and what public fund at this point. So no VCs yet per se. You can go to the next slide, maybe Perrine. Thank you. And so here are a few of my comments on raising capital. First, when you talk about seed capital, Series A, Series B, it really differs a lot on where you are and who you are talking to. Typically, and this is really a classic, if you talk to European investors and then you talk to Silicon Valley investors, there's a ratio of 1 to 10. So when you raise 1 million in Europe, you can raise 10 million in the Silicon Valley. That's really the ratio. But it doesn't mean that Silicon Valley is a wonderful place, because you will also see there that there are a lot more competition than in Europe. So if you're talking to VCs, in the morning and in the afternoon, they will talk to 10 other companies on the same subject as you are trying to pitch them for. So there's a lot more competition too. So even though the amounts of money are higher, it's not always easier to do that in Silicon Valley. Now there is also other areas in the US, like the East Coast, sorry, and the southern part, Texas, and that area is also booming a lot. I would say that they are between the European mindset and between the Silicon Valley. So when you talk about Series A, it really depends. Some say it's because of the amount of money is 1 million. Some say because it's 10 million. Some others will say it's more about having revenues or not. But it really depends. So you have to ask the person in front of you what do they mean by Series A. Second thing I would say is that when you raise, you should consider raising money almost all the time, or you should keep it in mind, because it takes a very long time to raise money, and then the money goes very fast when you raised it. So you should always maybe not be raising money all the time, but thinking about it and keeping contact with VCs or other investors that you have met. And if you have opportunities to pitch here and there, even if you don't plan to raise in the next 3 or 6 months, you could consider going for a pitch and then keep the contact with investors. Usually, most investors will not invest when they first meet you. That's quite rare, I would say, or it would be for smaller amounts. So it's good that you meet the investor a few times and they see your progress, they see you making more and more progress on the road. So the second bullet here, raise before you need it, that is very, very important if you want to have a balanced deal, because if you are going to go bankrupt in a few months or weeks, then you are in a very bad position to negotiate with investors first, and also you're very stressed, and you could do not the best thing for the company, right? So it's very important to raise or to start the process a long time before you really need it, and a long time is at least 12 months, I would say. So be careful with that, and don't underestimate the time it takes to raise the money itself. Also, it's a long process. You don't want to be cashless when you discuss with investors. I have two recommendations on the resources there at the bottom of the screen. One is a book which is called Venture Deals, and I think it's a nice one. I read it, of course, and I think it's very nice because it is written by both a VC and an entrepreneur. So they combine the two views, and very often you see the venture person giving some advice, and the entrepreneur say, yeah, but I don't really agree. I would do, in my point of view, this is the way to do it. So you can really view the two sides of the thing. You probably know Y Combinator, which is a very famous incubator in Silicon Valley. They're quite successful, and the companies they are incubate also, and they are pretty much in favor of entrepreneurs, I believe. At least when you read their papers, and I put a link there, you just search for SAFE from Y Combinator on the internet, and you will find documents that you can use to negotiate with investors. They seem pretty balanced and taking the point of view of both sides. Next slide. I have a few more minutes, I see. So you should also know that it gets harder in each round. So getting a seed investment is much easier than a Series A. Getting a Series A is much easier than a Series B, and so on. So don't be too happy when you first raise your seed, because it gets harder later, and you have to prove more and more things when you go to the next series. You will hear a lot of people tell you how to pitch, and there are pitch sessions and pitch trainings, and there are a huge number of them, and everyone have their different advice on that. So I would suggest that you listen to them, you take what you feel is good for you, and then you pitch the way you believe is right. It's obvious that if you follow the recipe that others give, then you have the risk of doing just like everybody else. And what you want to do is to stand out of the crowd, right? You have to show that you are different, that you will be doing things a different way. Third bullet point here is, don't forget that investors need you also to make money. If they collected money from a number of investors in a fund, and then they don't find any companies to invest, then they don't have anything to do and they won't make money, right? So it's important to understand that you need investors, but investors need you too, and they need the best entrepreneurs, and they need the best companies, right? So don't forget that, and demand a balanced relationship with the investor, and the mutual respect. If you feel very early that they are aggressive or they are not respecting you, then I think it's better to skip and to go to someone else. There are lots of investors, right? If they invest in your company, you will keep them for a very long time. So it's better to have a very good relationship, at least at the beginning. If you don't have a good relationship at the beginning, then it's going to be very bad. Don't forget that, investor will ask you many things. They will ask you for a business plan, maybe. They will ask you for a deck. They will ask you for a team, for the resumes of the team. It's okay. You have to give them all that information. It's fair. But you can also ask them for things. You can ask them for introductions to other companies. You can ask them for help. You can also ask them who they invested in previously. What type of companies they invested in. You can ask them for names of CEOs that they have of the companies they invested in, and you can talk to these CEOs if you really want to have a better understanding of the firm. And this is something you can ask them, and there are things that you absolutely have to ask them, and very soon, so you don't lose time and you don't make them lose time. You should ask them, what is the duration of the fund? Because usually the fund is 10 years and they recruit companies for the first 3 years, maybe do a second round and then they exit, right? So if you're not in the first 3 years of a 10 years fund, then it's going to be difficult to get investment probably. You should also ask them, how much do you typically invest? Are you investing 100,000 euros? Are you investing 500, 1 million, 10 or 50 million? So you will know who you have in front of you, and you will not talk to an investor whose minimum ticket is 30 million when you need 500K, right? So it's not impolite. You should really ask for the average ticket and also ask for the sector they want to invest in. Okay, some only invest in energy, some only invest in health, some only invest in AI, for example. So it's very important to ask these 3 questions very soon, so you don't lose time yourself and you don't have the VC lose time. Be careful, because some investors also do market research with you, so they want to know what you're doing. So because you're a competitor to their companies, but in practice you cannot do much about it. You just have to trust them and hope that it will go nicely. Next slide. Okay, I will be a bit over 10 minutes. Is that okay? Shall I continue for 1 or 2 minutes, or do you want me to?
That's okay, Vincent. But we will have to now start winding up. But what I see in your slide is very interesting. So please go ahead.
Okay, I think that's the last slide too, if I'm correct. First bullet point here is you often hear about an A plan and a B plan, right? What do we do if the A plan doesn't work? And it's a bit stupid to say so, but the best E plan is to have a B plan, right? So when you're trying to invest, find investors, it's very important if you have other investors that you can talk to, and that you have other ways to keep the company going. Because if you're really desperate for cash, then you're in a weaker position. So always try to have more than one option. And even if some investor is talking to you in a very positive manner and they say, we will probably, we are interested in you, it's okay, it's good. Continue with them with honesty, but don't close the other doors too soon. Keep on talking to others. One very good thing you could do is to try to find a friend or I don't know, an older person which is experienced in the sector, somebody that has been a CFO, a chief financial officer, or another CEO who is more mature than you and has raised money, because they will help you significantly. They will be less emotionally involved also, so they can give you more rational thinking. And maybe also an existing investor. So if you have friends and family and fools that have invested in your company initially, if one of those has some experience in raising fund, then it's a very good person to talk to, because they have the same interest as you have also, obviously. Don't raise at the last minute. I said that earlier. I'll repeat it here. because you will be in a weak position, then you will have a weak deal, and then you'll be frustrated for a long time, and then the relationship will not be good. If you have a hard time putting a value on your company, which is very difficult for most companies, for most startups, especially in the beginning, this is weird. This is not very often done, but I've seen that being done for a number of American companies, especially in the Silicon Valley. They say, the CEO says, I want to raise money. I don't know exactly how much, but it's going to be for 20% of the company. So if I raise 500K, that's going to be 20% of the company. That means that gives a certain valuation for the company. And then if I'm very lucky and I raise 2 million, it's still for 20% of the company, which means that the valuation of the company is much, much higher, right? So this looks a bit weird, especially to classic investors, but it also makes sense in the sense that if there is a lot of funding or many investors, it makes sense to put the value, the pre-money value higher, right? So you could think about this. It's not common, and most investors will probably not agree with that, but you can still consider it. Be transparent, honest, and ambitious. That's very important. So it's okay to be positive. It's okay to be ambitious and to say that you want to change the world, but you also have to be very clear about what you have been doing, about what you didn't work, and how you plan to fix it. Because if you say everything is nice in the best of worlds, it's not very reliable. Know your numbers, at least your main numbers, right? That's also important. And don't forget that raising money eats a lot of time and a lot of energy. And if you succeed and you get a lot of money, that's good. But then you should expect to have 6 months depression after that, because you will release all the stress for the fundraise. And that happens a lot of the time, that after raising money, the CEO or the CFO is a bit exhausted, and it takes some time to get back on wheels. Well, I think that's my last slide. I hope I wasn't too long. Can you go to the next slide? There's none, huh? Yeah, okay, let's finish. Thank you for your attention.
Vincent, thank you very much indeed. I found it very interesting and very honest and straightforward, which is what we're looking at. For everybody attending the webinar, which at this point in time, we have 53 people, please do write your questions as you go. On the GoToMeeting box, you will see a little arrow on questions. You can post them already. You don't need to wait until we get to the Q&A session. Post them already. Perrine and Manage will be covering them, and then we will get them back in a few minutes once Roger has already had the chance to speak to you. Now, Roger, can I ask you to chip in, please, and give us your VC experience and your messages? Roger unfortunately had a little crash on his computer. He's using another one without screen, so we do hear him, but we cannot see him. I hope that's going to be okay for everyone. Roger, are you with us now?
I am, yeah, sorry about that. You can tell I'm not a tech VC, right?
I'm not either, so I'm all done.
Great,
Wonderful.
okay.
Thank you. Floor is yours, Roger. We'll get your slides. You ask for the new slide whenever you need.
Great. So yeah, next slide, please. Right. So yeah, just to introduce Hadean. So we're a European venture fund that is focused exclusively in the life science sector, and we're based in and focused on particularly the Nordic region. So I'm personally based in Stockholm, and the company's headquartered in Oslo. But we do invest globally. In terms of the team, we're the 4 senior people in the fund have all previously worked together in a London-based kind of global biotech fund. In this fund, we're investing across all of life science. We do therapeutics deals, devices, diagnostics, and digital. And the Series A fundraise, I guess, is our sweet spot. That's the type of deal we're looking to do. And in terms of the fund size, we're just a bit over 60 million euros. So we're obviously looking to build a portfolio of somewhere between kind of 10 to 12 companies. So that's just a bit of background on Hadean Ventures, but I won't dwell on that, because obviously we'll talk about the lessons that are relevant for companies. So I was asked to talk about kind of what the key criteria are that VCs use, and there's obviously, I've divided this into kind of the obvious and then some of the maybe less obvious things. So I guess the obvious criteria, and as I said, we're a life science venture fund, but I guess a lot of these will be common, is, you know, all VCs are looking for large unmet market opportunities, right? Most VCs are not looking to build small businesses, they're looking to build businesses that can become kind of global winners. So that's the number one most important factor that has to be there. You've obviously got to have a differentiated and protectable technology or product, and I think it's the protectability of it, particularly in life science, is obviously absolutely critical. So make sure that you know all of the detail around that and are ready to talk about it. It's unbelievable the number of meetings that you'll have where you ask, when does the patent expire, and you know, I don't know, right? Those kind of basic questions have to be, the answers to those have to be known. I think for most VCs, certainly in life science, you know, having a big opportunity and a kind of niche or differentiated technology is one thing, but I think most people are looking for that to be underpinned by some robust and excellent science. It's a fast-moving world, and if you don't have that, you can very easily be overtaken. Fourthly, obviously, most VCs will look for a very experienced team and a track record. That does partly depend on the region you're operating on and the stage of investment. Obviously, you know, in some cases, a VC may like an asset so much that they're willing to go with a team that hasn't been fully built out yet and can help with building that team up. In other cases, they're looking for a kind of pre-formed team. I think having heavyweight, you know, relevant advisors is important, both as a kind of signal of the quality of the company and also as a in terms of practically the advice that the company can get on board. And then I think a really important thing is ambition. I mean, willingness to do what is required to build a globally significant asset and a company. So I think most VCs, if they get wind of the idea that you're looking to kind of drip-drab small amounts of money in and, you know, progress slowly and so on, I mean, that's of no interest to most VCs. They want immediate and obvious ambition. Next slide. So I guess these are the softer criteria, but also things that are, you know, I think in most cases absolutely critical. So I mean, first of all, likability, as Vincent mentioned, you know, you're going to be working together for a long time, perhaps 5 years or more. So we need to be able to get on with each other, and we need to be kind of likable with each other. I think honesty, you know, obviously it's absolutely critical that, you know, in the first meeting, you know, you want to give a good impression, but at the same time, don't hide, you know, bad news. You know, the bad news is going to be found at some point, and when it is found, it'll undermine trust. So really important to talk openly and frankly about the business. And, you know, fundamentally, if it's a great business, then people will look through small pieces of bad news. But if you don't talk about that, then it just undermines trust. And I think that is the worst possible thing that could happen. I think I've listed here empathy, which may seem a strange one, but I think it depends on the region, obviously, but I think there's, you know, many entrepreneurs can be suspicious of venture investors. I think it's really important to try to understand what venture capitalists do, why we do it, the way that we make money, and therefore to build a kind of empathetic relationship where you understand what each other's incentives are and what you're aiming for in a transparent and open way, so that there's empathy there rather than just suspicion. I think in terms of the way you interact just in meetings or with other people in your business, I would say as a general rule, you know, hierarchy is not something that venture firms want to see too much of within, certainly within the senior echelons of a company. You know, we want to invest in companies where, you know, people listen to the best ideas and take them on board wherever they come from. So I think that's important to demonstrate. And then finally, answer the question. It's incredible how often you know, you ask a question and you get a kind of round the houses answer to a different question, or kind of being told that it's the wrong question or not a sensible question or whatever. I mean, if a VC's asked a question, then they need to know the answer to it. Next slide, please. So briefly on kind of approaching the process, I think first of all, before going into you know, a substantial funding round, which a Series A will be, you need to fundamentally make the decision as to whether or not you actually want to go down that route, right? I mean, there are certain realities of getting on board serious venture funds or multiple venture funds, and that is about an ambitious, fast-paced route, right, which involves obviously giving away a share of the company in return for money and for other experience and help. But let's be frank about it, that does imply less control than you're used to, because prior to taking on the investment, you may have either complete control of the business or a large number of small investors. And that's going to be a big change for you. And fundamentally, you have to make that decision as, do you want to go down that route, or do you want to remain in a different environment where you maybe take on less money, go slower, and in our view would be less likely to succeed, but it's a legitimate route to take. So you need to make that fundamental decision, and I think unless you reconcile yourself to that fundamental choice, then the rest of the process can be very difficult and painful for both sides. And so I think not doing that, it leads to most of the kind of pitfalls that we find when you're negotiating with a VC. Next slide, please. So in terms of negotiating the Series A, and obviously there's a huge amount of detail that we could go on for a long time, but the key aspect, I think, is discuss some of the key terms very early in the process so that you're not wasting time. Okay, now I think there's a distinction we make between kind of heads of terms and a term sheet. And I think heads of terms is a more informal document where you can establish the rough outline of a deal, where the valuation is going to sit approximately, where some of the other terms are going to land in terms of liquidation preference, any other special rights, what the structure of the board might be. Very important, I think, to get that out in the open early on and ascertain whether you're living in the land of the possible before you waste a lot of time on both sides. Save your negotiating strength for what your key aims are. Understand before you go into the process what are the things you can't compromise on, and what are the things you can compromise on. Amazing how common I've found through my career of companies negotiating hard on points that are largely irrelevant for both sides, and I think that usually comes with emotion. So there might be particular points that are for some reason emotionally important, but I think you need to have a very rational, objective view of what your interests are and make sure you preserve your negotiating strength for those things. And I think there's nothing wrong with being a tough negotiator, and I mean VCs want to see that, right? Because you're going to be negotiating with other people in your day-to-day business. So showing determination is fine, but I think devious or Machiavellian tactics risk polluting the relationship, so I'd avoid those. Next slide, please. So common pitfalls. So I was asked to kind of describe what I thought those would be. First of all, as a valuation, obviously it's always a contentious point, and I think you need to understand what is possible from the VC's perspective, and the shape of that is defined by the economics of the industry, which is that for a successful home run opportunity for a VC, they need to be making a 10 times return on that. So in the scenario where everything goes as well as it could possibly go, all the clinical trials work, you get bought for a great amount of money, that needs to deliver a 10 times return, because the economics of the industry mean that VCs are expecting perhaps even a majority of their investments to fail. So you're simply not going to get a VC to invest at what you think the fair value of your business is, because if the VC was to do that across the board, their fund would just return whatever the cost of capital is on average, right? Which means they wouldn't be able to raise another fund. So you've got to understand and obviously that's a gross simplification, but you've got to understand the economics of the VC industry to understand what a possible scenario is for them. The second area is special control provisions. I think this is a really often a sensitive topic. I think it's legitimate that the VC is looking to protect how their capital is deployed, given that they're providing that capital. It's not legitimate for them to try to micromanage the business. So I think strike the right balance there. Know that there are going to be some of those terms, but legitimate to push back on others of them. And then finally, avoid surprises. We're a relatively small VC, and we're not that bureaucratic. Larger, more established players with large numbers of investment professionals, politics get involved. There are investment committees. Don't put the guy who's cheerleading your deal in a difficult position by pulling last-minute tricks and forcing them to go back to a committee of skeptics with worse terms than they presented last week. And that's a really important thing not to do. Next slide. I think that may be the end. Yeah, thank you. Good luck.
Roger, many thanks indeed. I think we're catching up with time. We still have a short 20 minutes for Q&A maximum. I encourage you to post questions. I don't see any on my screen, but I'm pretty sure that Marta and Perina may be getting some. I will start and shoot a few questions to both of you, Vincent and Roger. You both spoke about expectations, your expectations and the VC expectations in the case of Vincent. Let me ask you something straightforward to both of you. Vincent, when you go and meet an VC, do you already do your due diligence in terms of ticket size, growth targets, how much are they demanding from you to be on a monthly growth and a yearly growth, market share goals, team approaches, how much do you know about them? You mentioned that you should probably stay away from VCs if they are not within the first 3 years of their current fund, the one that they are currently investing. How much more do you know about them before you go on the road? Vincent, I think we've got your microphone off.
Yes, now it's on. Okay. So it's, yeah, of course you cannot know everything in advance. But if you should at least study the website, because if the website is good, then you will get a number of answers, right? So that will help you predefine if the VC or the investor might be a good fit. Then very early on in the discussion, you should ask those questions. What's your ticket size? Well, at least a question you don't have an answer yet to, and have a very quick discussion to see if there is a fit or not. Also, VCs, usually you don't cold call them. It's not very hard. It's not very easy to do. You can do it, and sometimes it works. And some VCs also suggest you cold call them, but most of the time you get a mention to a VC by a friend or another entrepreneur or another fund, so they already have some information about the fund and their objectives and their ticket size and what they're looking for. So yeah, so it really depends, but at least you should read the website and know a little bit about what they do. Otherwise, they will quickly see, okay, this guy is not doing their homework, so doesn't look very serious as a first step.
Roger, can I chip on that? You said that you're looking for unmet market opportunities. That means that you're probably going to be very restrictive when you start selecting from your whole deal flow companies that approach you to the ones that you actually want to talk to. What is the best way to approach VCs in general and yourselves? Because if one entrepreneur sends you a teaser, is that going to be looked by an assistant and you sort of get an automatic answer that it doesn't meet the criteria? Is it much better to get a reference from a friend or another entrepreneur in your portfolio or somebody that you trust? What is the best way to get to you?
I would say that the best way is actually to, as most companies do, obviously, is you will find they kind of send emails, right, and it's normally a teaser or a slide deck or whatever. But I think it's really that the most critical thing is what is in those first. We certainly, I can't speak for the whole industry, obviously, but we certainly will. We always open those emails and read those emails. But if in those first 3 or 4 bullets you communicate the key value proposition and the key aspects that a VC is likely to be focused on, that will hugely aid your prospects of investment. So, for example, if I was to receive an email with 3 bullets that says, I don't know, oncology asset, patent to 2035, preclinical completed, entering phase 1 next year, X on the board, that's much more likely to grab my attention than please see attached 50-page presentation, which doesn't get to the point until about slide 12. So I would say clear communication that gives the VC enough information to decide very, very early on, is this something I need to pay attention to, or is this something I can ignore?
Okay, fantastic.
And I think as you said earlier on, or Vincent said earlier on, I mean, VCs are also looking to, both companies need VCs and VCs need companies. So, we're looking to deploy capital. So, we're not in the business of simply ignoring anything that hits our inbox, but it needs to grab our attention.
Okay. Well, thank you very much. I see that there are quite a few questions. Marta and Perrine, do you have you been able to pull something together?
Yes, we have many questions. Someone is asking how long from first conversation to raising 3 million euros?
Well, yeah, we did that in three rounds, actually. Yeah. The first one, I was looking for 500,000, and I only talked to friends and entrepreneurs and people like that, and I was extremely lucky to raise 1.3 million, so more than the double of what I wanted to raise, and still at a very good value. So that was a surprise to me, and that was not a conventional way to do things. I must say that I'm over 50 years old, so that also helps, because my friends are a bit more older too, and they have better positions. So that's a bit unusual. And then 2 years later, we raised another 700-800K, and 1 year later again 700 or 800K. So that's 3 small rounds like this. Well, 1 bigger and then 2 smaller, and total is 3 years. Now, when you say I want to raise money, between that moment and the moment you really have the money, it's easily 9 months to 12 months, because you have to find the investor, you have to pitch, you have to meet them, you have to write a term sheet, and then you have to negotiate, you have to see lawyers, and you have to do due diligence. So there's a lot of things to do. Less if you're on seed, more if you're on Series A, even more if you're on Series B. Sorry. So yeah, and if you talk to investors from other countries, that makes things more complicated, because the legal differences may be a complexity that you had. So I think that more or less covers the question. Yeah.
Yeah. Can I pull together a couple of questions I've read myself here? Some people are asking about whether it is better to approach the VC directly on their own, or whether they should go through an advisor, a fundraiser. And some other people are asking that they getting approaches from supposed VCs from the Middle East directly to them via LinkedIn. And I wonder whether that is more of an intermediary type of approach or not. Do you have any view on this? Maybe Roger more than Vincent.
Sure. Yeah. I mean, I don't think either with or without an advisor is a red line for most people. I mean, in general, we prefer without, because I think that having direct lines of communication, the fewest barriers that there are between us and our ability to ask questions and get information and so on, the better. But I don't think it's I don't think it's a critical issue. The only thing I would say is that it does sometimes it reflects it reflects how hot, I guess, a funding round is, right? If you most VCs, I guess, would look at an opportunity that comes via their network, i.e. other VCs, or directly to them, in a way that suggests that deal is a deal that's more in demand than where a company's hired an advisor, because that immediately suggests that it hasn't been necessarily easy to get the round done. So it does, in some ways, send a bit of a signal. not necessarily a positive signal. But that's not a. There are situations where it makes sense. There are situations where it doesn't make sense. I don't think it's a red line either way. But just at the margins, that would be my view.
Okay, good, thank you. There's a couple of questions away as well about liquidation preferences. So the question is whether you still use them, they seem to be disappearing from the market, or whether the investor is using some backup by BPI or some other mechanisms. Roger, maybe for you as well?
Sure, yeah, I think it varies a lot by sector. I mean, obviously we're life science investors. I think it's still very common in life science investments to have a liquidation preference. Probably less common in tech. So I think it's it's still a common tool to obviously provide some level of protection for the investor. So yes, it's something that is still out there and very common from our perspective. And we most of the time would look to have liquidation preferences in our term sheets.
Okay, wonderful. Vincent, this one is for you. I've got a couple of questions here on two different topics, but I think they're related. One of them is, what should be the percentage ownership of founders before Series A? I'm asking you because I think the VCs will have a little bit of a different opinion. And a question related to this, because it is about dilution in one way or another, is did you offer different types of shares to your business angel investors and to the fund investor? I know that in some countries the different type of shares are not an option because legally they will not work, but in some others it is an option. So what is your view about these two things, Vincent? Percentage ownership of the management team and then different types of shares.
Okay, yeah, I don't think there is one unique answer to that. It depends on many factors. Do you have a 1 or 2 founders company or 5 founders company? That makes a difference. The various stages at which you are also. Some Silicon Valley and American investors that you should give 20% at each round, something like that as a maximum. So that means obviously that at the first round you keep 80%, and then on the next round you do the math, but you try to give 20%, but it's very it can apply sometimes. It depends on the revenue you're generating or not. It depends on the amount that is being invested also. It really depends on the investors, and the mentality in Europe and the US is also very different there. So in my case, it was more or less the case that I gave 20% on the first round, or a bit more. And then on the successive round, it was similar to that, but it really depends. For the second question, what was it again?
No, it was about the different shares, whether you give different shares to the BA and to the venture.
Well, I personally like to keep things as simple as possible.
That's why I linked them.
Pardon?
I linked the two questions because it will dilute you in one way or another.
Yeah, correct. So in our case, the first fundraise was pretty easy, I would say, because there were lots of investors interested, and there were more entrepreneurs than VC. So entrepreneurs understand entrepreneurs maybe better also, and they really it was their own money also. So it's in some ways it's easier to do what you want with your money. When you talk to a VC, usually the person you have in front of you is not the one that put money in the fund. He's working for the fund, so he has more stress on his shoulders, and he has to reach targets and goals. So he is a lot more demanding usually than an angel. And then are the conditions different? I would say, unfortunately, yes. If you can avoid them, you should try to have the simplest condition as possible and to have them apply to all. But usually it's very different because the next rounds, people, the investor want different conditions. In our case, all the business angels had the same conditions, and there was a public fund that wanted to have different conditions because that's the way they do usually, and so on. So we had to accept a number of special conditions, even though I didn't feel it was a good idea or it was fair to everybody. But sometimes you have to accept some conditions, yeah, to make it work.
Roger, on that line of thought, a little bit of a complex question that I'm mixing here. People are asking about that fundamental decision of whether you want slower money, and I've read in your slide that you're including business angels a little bit in that slow money and making the decision to go for VC. But then other questions are asking about what happens if some investors are okay with giving you a loan with convertible elements into that at a future valuation, and some other investors are not okay with that. And additional questions are about precisely that line of different investors. What happens if you find that one of investors is including maybe family members into the management in one way or another, which was not at all the purpose of the thing? How do you manage that kind of process? And I suspect that venture capital is coming towards the later end of the process of the company. You already have a little bit of a, if not a methodology, at least your very clear ideas of what you accept or what you like and what you don't like. Could you comment a little bit on this?
Sure. Yeah. No. So I think when I had on my slides that question of the fundamental choice, it was really not so much a question of for that individual round what the details of the financing are, but more a mentality, a state of mind. The sector that we work in, life science, is a sector that has the timelines have shrunk hugely in the last decade or decade and a half. Things move much faster than they did before, and therefore the necessity of getting your act together quickly and executing quickly, that necessity has grown in importance, and therefore that's the reason that I brought that point up. So it's really a question of barriers to delivering the business plan quickly. If a company takes on board some money in a Series A financing round, and then but is not really fundamentally made that decision mentally, then when it comes to the next funding round, do we waste months and months and months around terms when we should be executing clinical trials, hiring people, launching trial sites in the US, doing all the things that create value for the company? So that's why I said it's important to make that fundamental decision and to understand the consequences of that decision. And I think in terms of the other questions you brought in, I mean, I think that, and obviously there's a huge number of different situations. It depends on the situation, but in general, keep things simple. I think having for example, you mentioned family members involved. Maybe you've got some people working part-time for the business who are shareholders or relatives of people who are shareholders and so on. I mean, things that just create complexity and conflicts of interest and so on, are to be avoided in general. But obviously, it depends on the situation. I've also worked with companies where you've got husband and wife teams, and it's absolutely great. So it depends on the situation. But keep things as plain vanilla as possible before the VCs get involved. Things that there's enough prospects for it to get complicated later on.
Thanks. A question to both of you. There's a question and a side question about ambition. It says, if fundraising Series A is about 1 million and beyond, what should be the next series level? What should be the expected growth from the company that should be linked to that 1 million Series A? And when should further fundraising happen? This is all very theoretical. I know that this is a case by case, company by company. The world looks different, but it's a general idea.
Yeah, I mean, from a life science perspective and within the therapeutic space, which is the area that I know best, I mean, it's those questions are answered by the clinical development plan, right? So, I mean, if the Series A funds the phase 1 study and the Series B funds the phase 2 study, then it's a simple matter to work out what those numbers look like, right? So I guess if you want round numbers, I mean, a phase 1 funding Series A of somewhere between 5 and 15 million euro, followed by a Series B of 20 to 30 to fund the phase 2 is kind of typical.
Mm-hmm.
Yeah, and probably, Roger, those companies are still generating zero revenue because they're still in trial phases, right?
Exactly.
Yeah, so you see in this case, you have companies that live for many years and raise quite a significant amounts of money without any revenue until they get on the market much later. And that's one extreme, I would say. And on the other extremes, there are investors that require the company to generate revenue soon or after 1 or 2 years. In our case, we did not generate revenue after 3 years, and now we're starting to generate revenues, but it's still pretty low, right? So we are a medtech or health IT or digital health company, which is a different matter as a biotech. Yeah, it really varies a lot. So I think what's important is to put down numbers of what you have done in the past, what you think it will do in the future, and then you put the investment of the investor in those numbers to make it look like things are consistent and you know what you're talking about. And probably you should avoid to have those graphs that go, like that, like the hockey stick, because everybody's showing those kind of graphs, and it happens very rarely too. So just do your math and try to build a story that looks convincing, that seems to make sense. And then for the rest, everybody knows that no business plan is ever respected anyways, right? So, yeah.
Thank you. Vincent, I'm going to ask you something, and I'm afraid that we will have to start wrapping up. David Rowe is asking, how much of the company did you give up for the 3 million?
In my case, I was the only founder initially, then a co-founder joined me later. So the situation is a bit different. I think I have about 50% of the company after raising 3 million, 50%, close to that, a bit more or a bit less. I don't remember, I don't count.
Money 3 million, post money 6 million.
Yeah,
All second partner that might have changed in the process.
Well, the valuation is different, but yeah, it's more or less like that.
Okay. Some people are worried about what is the level of control that you would be willing to give up, and what do you consider micromanagement? I think this is a concern by everybody, and I would like to get first Roger's view on this, because I don't think that giving up control by the entrepreneur is a good thing, but I actually don't think that investors want it either. But there's a limit. You mentioned that, Robert, about how is the cap being spent. Can you pick on this question, please?
Yes, exactly, and it's a fine balance, right, between legitimate protection of an investment that is for a specific purpose. So, for example, if a company is raising money to run a particular series of experiments or a clinical trial, most investors will not want the company to be able to make a fundamental change to that, or to use those funds for entirely different purposes without any ability to have an impact on that. And I think that's it doesn't mean to say things may change, things may need to change, and that can be discussed and agreed. But to be able to do that unilaterally, I think most investors would find that difficult, particularly if we're talking about a very large amount of money being invested at for example, in respect of a clinical trial. So I think that kind of thing is relatively common. I think where it gets to, the examples where VCs have looked to have kind of micro control over small spending decisions and so on. I mean, that gets into the realms of what I would characterize as kind of mutually destructive micromanagement. and that obviously should be avoided. So I think it's I think it's good as an entrepreneur to keep in mind, what is, if you were the investor, what would you not want the company to be able to do with the money that you've invested, versus what is just a kind of attempting to micromanage your business. It's a balance that has to be struck in each individual circumstance, but the principle is that if an investment's for a certain purpose, then the VC is likely to want the ability to ensure that that's the purpose for which it is used.
Yeah. A last question that I'm trying to group, and we need to close now. There is a question about what happens when the fund expires. That means you're approaching a VC, you're drawing money from them, you get to the end of the fund, what happens? And some people are concerned here that maybe they force you to an exit. I had a question ready for you that was about, can you, Roger, and it was a question for Vincent, but I'm asking both of you, can you, Roger, invest from a second fund? Or is there a conflict of interest that you can actually not manage because of different investors in different funds?
Yeah, so I mean,
not be forcing an exit. But,
sure. No. So answering the second question first, so the one about the second fund or different funds investing. I mean, the general there is no absolutely black and white answer, but in general, it's problematic. So I would say that I've experienced many situations over the years in which funds have not been able to invest or have not chosen to invest in that scenario. So that can be a problem. In terms of forcing an exit, I mean, yes, the reality of the venture industry is that over the period of a 10-year fund, for example, investors are looking to generate a return, and that's why the expectation going in will be that that's the period of time during which there needs to be an exit of some kind. That doesn't necessarily need to be an exit that involves selling the company. It could be an IPO, for example. But yeah, that is for most funds with a fixed life cycle, that is an issue, and it's an issue that you should, as the entrepreneur, you should be aware of and understand before obviously taking on board that investment, because there is no real way around that, right? That is just a feature of the industry.
Roger, that was a very thorough answer. Vincent, if that's okay, I'm going to skip your answer now. We are way over time. We still have a few questions. I think we can go on the whole night, but that's not the purpose. For everybody here, important. This webinar is going to be posted on the platform, so you can watch it again. You can review the questions. I don't know if the team will be able to keep the questions that we got out there in the list as well. What I do know is that we do have a survey for you. We need your feedback, whether you enjoy the webinar, whether you find it useful, how can we improve it? Obviously, I can read faster eventually the questions and try to come up with more answers from the candidates, but that's as much time as we had, I'm afraid. So please do not forget to fill in the questionnaire. Vincent and Roger, an enormous thanks. I know that we have deterred you away from your important business for more than an hour now. So wonderful that you made the effort to prepare the slides. Wonderful that you were with us today. And thank you very, very much indeed for sharing your experience for the benefit of the entrepreneurs listening to us today. Thank you, and see you very, very soon indeed. Bye-bye, everybody.
Thank you for having us. Thank you. Bye-bye.
Bye.